And we're on. So thank you so much for joining. My name is Chantal Sanchez. I'm with Pacific Sotheby's Real Estate, and this is Alex Shelton, and he is with Loan Depot. Alex, if you want to just give me a little bit more information about you, and I know you're in Palm Springs, but yeah, just give her a little bit of introduction.
Absolutely. I'm so excited to do this with you today, Chantal. Thanks for having me. This is going to be a lot of fun. Alex Shelton with Loan Depot. As Chantal said, I've been in the mortgage industry for 7 years. I work for a company, Loan Depot, and I'm a mortgage banker. I have my mortgage license, real estate license, and have a small team of people that I produce loans with here in the desert.
Right. And it's very important, especially if you are buying property out here in the desert, it's important to work with a local lender who understands all the nuances, such as land lease, or different types of private leases that we have on properties that some other areas, such as people in Orange County or maybe Los Angeles, might not be aware of, or even in San Francisco.
Yeah, we live in such a unique market. You said it very well. You know, we've got tons of condo complexes. They're all different. Lease land is a huge factor here. You know, just even with appraisers, you know, it's really important that we're working with local people, because in this unique market, there's a lot of room for error if somebody doesn't doing or have the relationships in place.
That's very, very true. And so just, you know, with that said too, and also we work together, and we're our families and our friends, so we're able to see each other often, which is very nice. And, you know, one of the reasons I wanted to talk to you about today was we're in a very unique position. Also, first off, wanted to say I'm glad that you and your family are safe and healthy during the crazy times. But we're all trying to find unique situations, and we're trying to find a little bit of calm within the chaos. And what I wanted to talk to you about today is, first, you know, are we going through a recession? Are we going to be in a recession?
You know, I think that we were already destined for a recession, but with the COVID-19, it sort of catapulted us into a recession quicker than anybody hoped. 2020s are always sort of been the year that everybody's been talking about for a little bit. But I do think that with what's happening right now with the sickness and people not being able to go to work, it's catapulting us a little bit quicker than everybody had anticipated. So yeah, I do think we are headed for recession, not just because of COVID, but just because of what's happening with the market in general.
Right. And also it's kind of just part of a cyclic, or you know, the economy moves in that sort of direction where, you know, when you have highs and you have lows. Now, of course, you know, this recession, though, people are having fresh in their memory about 2008. And that was a housing crisis. Now, I know that a recession doesn't always mean a housing crisis, but in what way are we different or similar to the 2008 recession?
So we're similar right now in the fact that the mortgage world is sort of upside down, and there's a lot of reasons for that. We're sort of in this perfect storm when it comes to lending because of COVID and what happened before COVID. So let me start at what happened before the virus broke loose out here and everything closed down. Rates improved drastically, and that flooded the gates for refinances. Let me put it in terms of numbers for you. In a typical year in the mortgage world, it's typical for there to be about $2 trillion in refinances. Before COVID, we're trying to do $5 trillion as an industry as a whole in 1 month.
Wow.
You can imagine what sort of pressure that has put on not only the turn times for the mortgage world, but also the amount of money that is being promised up front. Now you introduce this virus that has driven the industry down and driven the economy down. Well, when lenders go to lock a loan for a client, a loan is generated upfront by a mortgage company, let's say. They're reserving that money for a particular rate. For servicers, so when a loan gets originated, it goes to a servicer will protect themselves by hedging a rate in case that rate goes up before the mortgage is funded. So then you have the government buying mortgage-backed securities to try to keep interest rates down. Well, now these hedges that these lenders and servicers have put in place are pretty much worthless, and they can no longer offset the rate with their hedge. So now they're seeing what's called a margin call. And that means that the servicer has to have a particular amount of money in an account to make the investor feel comfortable. Well, because the Fed is buying these mortgage-backed securities, they don't have the hedge money coming in, and now there's a lot less liquidity that the lenders have to originate a loan. Now you
Right.
couple that with, and I know we're going to get to this in a little bit, but with people being unable to make their mortgage payment, and it really puts banks in this catch-22 where they're seeing a lot of pressure from both sides because they don't have money coming in. They need to pay an investor. They're obligated to pay an investor, but if the mortgagee isn't making the payment, then that's even less money that they have. So now they don't have money that they expected to have coming in from their hedging, and now they also don't have money coming in from the people holding the mortgages, and they still owe money to Fannie and Freddie or whoever happens to be the investor. So I think that the mortgage industry as a whole is in a really tough place right now, and it'll be interesting to see who's been prepared for this, who can ride it out, and if the Fed will listen to the cries from the mortgage industry to stop quantitative easing, or at least ease the easing, if that makes sense.
No, it definitely makes sense. And hold on, I have all the kids in here. I
Hey
forgot to
guys.
lock the door. And so they all just barged in.
Of course.
Anyway, no, it definitely, it makes sense because the situations are very similar, but at the same time, they're very, very different. Um, you know, but I'm just wondering though, previously we had the housing crash. Well, the recession was kind of caused by a housing crash. This you're saying that we might, the recession was already set to be, but it's just that there might be a price correction caused by the recession, right?
Yeah, this has sort of been a catalyst for the recession. So I do think that after this is all said and done, obviously people are struggling with the ability to go back to work. A lot of people are probably racking up some credit card debt. Some people may not be able to pay their mortgages. I don't know how that's going to affect home prices.
Right.
Some mortgage companies that can't ride out the storm may not make it through. So I don't think there may be a couple similarities between 2008 and today, but it's not going to be as drastic because the only reason people aren't working is because to stop the spread of the virus. So as soon as that's gone,
Right.
they're going to be back to work.
But some of them might not have jobs to come back to. I mean, that's another situation too. You have the restaurant work, you have the bar industry. A lot of movie theaters might not make it, might not be able to ride the storm. So that's going to be an interesting thing to play out too. The other, I guess my other question is, do you think that there's going to be a lot of foreclosures like there were in 2008?
I don't know. I do think that the banks are doing everything that they can to ensure that that doesn't happen. The mortgage industry as a whole is very stable. And that's why when people go to get a mortgage, they're harassed for so much documentation. It's because the mortgage industry set themselves up to avoid what happened in 2008. So they want to be sure that people have the ability to repay their loan, whether they have reserves, their job is secure, they've got some equity, their credit looks good. All those factors come into play to create what's called a qualified mortgage. And when a bank produces a qualified mortgage, that means that even if somebody misses their payment and they go into foreclosure, the bank is insured by Fannie and Freddie to recapture that money. So the banks are now insured because they're producing quality loans.
I heard that the non-QM loans as of last Wednesday are just non-existent.
Yeah, that's pretty much true. They're already leveraged in a position to be very high risk, and that's why they cost more and they could be more expensive because they are a high risk loan. It's could be for people that don't have income that they necessarily report in a way that's favorable to the banks, or they've got some credit issues, or they've got some liquidity issues. So because a lot of those banks are not very liquid, they don't have the money to continue to fund these out of the box loans. And
Right. And I think that's really important to know, because right now, there might be some buyers who are thinking, okay, well, maybe further down on the road in a month or 2 or 3 months from now, home prices will drop significantly. And then maybe I can afford a house, but then they're going to be competing with cash buyers at that time, right?
possibly, my thought is if you are a cash buyer, you probably had a lot of that cash in the stock market.
That's true.
And so if that's the case, then I do think a lot of these, I mean, you and I are in a cash heavy market. It's a lot of second homes and investment properties. There's no question.
No, absolutely.
But I feel that people who didn't leverage the bank may now be thinking that it's a direction to go, because if you paid cash for your house and the price does drop, then that cash that you spent up front is already worth less.
Right.
Whereas if you got a mortgage and you leveraged the bank, then it's not you holding the bag, it's the bank, and the bank's insured. And then, you can keep your money in that investment account that is tied to the stock market and hopefully ride out the storm and replenish those funds, and then maybe end up paying your mortgage off, when everything comes back to normal. That's my feeling that I think people will start to do is, the cash buyers may reconsider paying cash.
What advice would you give to buyers who are perhaps going to be listening right now, and they are thinking to buy, but they're thinking to wait? Or just in general, what advice would you give to buyers from a lender's perspective on just random kids? They're supposed to close the door.
That's why this is so great. It's just everybody's dealing with this, so it's okay. I've got dogs running around at my feet, so
you just can't see them.
yeah.
I know, this is just like working from home, working parent from home.
It's all part of it.
Right. So, what message would you give to buyers? Because like I said, I want to be able to give the most. My job, as a real estate agent, is to educate and inform my clients as much as possible about all the information that is needed, before they can make the best decision to buy or not. So with that said, what would you say is the most important, let's say top 3 things to inform buyers?
I would say number 1, listen to your professionals in your sphere.
Right.
Don't listen to social media. Don't listen to your friends or family unless they are a realtor or a mortgage person.
Sure.
Opinions are great, but everybody's got one, and they aren't always right. So it's very important to listen to the people that have been doing this for a long time and are entrenched in it every day. So take the advice of
Absolutely.
the professionals. I would say that's number 1. Number 2, stay positive, but be prepared. So if you're looking to refinance, get your application in now, because when all this starts to settle down and the virus starts to not show any more signs, I do feel interest rates are going to stay low for the rest of this year.
Okay.
But you're going to be competing against everybody else that's going to try to refinance at the exact same time, and you may not be able to get through. So stay ahead of everybody. Get your application in, get your documentation in, so that way when the time is right, your lender can lock in that rate for you.
Okay, that's really good to know. Third, you had a third thing?
And the third thing, I would just say to be patient. It's going to take a little bit of time. I would say it could be 30 to 60 days before we start to see some light at the end of the tunnel with all of this. But, we always recover. Even in 2008, the worst crash, one of the worst crashes we've ever seen, look at how great the economy has been since then. So
I know.
we will recover, but you
Right.
want to make sure that you are in a position to ride the wave when it comes, because I think the stock's going to rally very quickly, and you want to be in a position there to take advantage of, if you're an investor, low stock prices. And
Right.
if you're looking for more of a safe haven, and are maybe looking to retire and are tired of seeing the waves in stock, and you want to put your money where it's a little bit more safe, real estate has always been
Absolutely.
a safe.
Yeah. And if you're dealing with, I don't do if you deal with commercial commercial clients a lot, but for them too as well, the prices are going to be probably dropping a little bit. It was interesting because when we first kind of emailed about this, you told me that 2021 is set to be the real estate year. What did you mean by that?
So I think that because home prices, it's hard to say. We're in such a unique area of real estate. We're, like I said, we're mostly second homes and investment
Right,
properties. It's really hard to gauge what's going to happen with home prices. There's still more houses. There's still less houses, excuse me, out there than there are people that want to buy them. Even
sure.
before this. So given that the
Inventory.
lack of inventory has been a factor, I think it will still be a factor. I don't see people, if home prices go down, people aren't going to be excited about letting their house go.
Right,
So it could be even less inventory out there.
right. Because
So
that was part
it's
of the
hard to
problem
say.
already to start with, is that we don't have that much inventory out right now. Of course, other markets are different. Every city's different. But I know in especially Los Angeles, they have a way bigger inventory problem than we do here.
I
But
think, sorry, go
no,
ahead.
go ahead. No, just children.
So the reason I think that is because I feel a lot of people with Airbnbs are suffering right now.
Right,
And, if this happens again and they can't make those payments, a lot of people are probably dwindling their savings right now, just trying to keep those vacant Airbnbs open.
right.
So
Or
when this is
or
done,
what I'm seeing too. I'm so sorry. When I with the I got distracted, but the with the Airbnbs and businesses, what they need to do is they need to rent it out long term instead of Airbnb, and that's hurting their business because Airbnb makes better profit than long term rentals, and I've
so
seen that. So
yeah.
for them, it's just a matter of it's just a matter of getting that together. Do you have any other advice before I run off and take care? Hold on, Max, you want to say hi? Yeah, he's listening and already he's working on real estate right now. Um, but it's it is a kind of a crazy situation with with the current economy. I'm hoping that we recover quickly. I'm expecting for there might be some price correction, but I don't see it being long term or as devastating as 2008. Of course,
No,
depending. I'm sorry.
I don't see that as well. I do think that people that are heavily exposed in real estate may think about putting their homes on the market, especially if they see home prices are going to go down. They may, if there's a flurry and people start getting nervous that home prices are going to go down, that could create a panic, and a lot of people could start putting their houses on the market. If that's the case, it's going to be gangbusters for real estate, and it's going to make affordability
Right.
very good. And that's something that we have a big problem with here in the desert is affordability.
Absolutely.
So either way, it'll be a good thing, because if people find they're able to afford houses out here, it's going to bring out a lot of first-time home buyers. If prices
Right.
continue to go up, the investors are still going to come out and buy. So I think either way,
We're unique. I think we're unique that way. We of course there are offers. We get multiple offer situations, but it's not like, again, like not in Los Angeles where a house that's under $1 million might have a 36 offer situation, because there's just not enough inventory and anything even in like mid Wilshire. But
and
out
a
here,
lot,
like, I'm sorry.
yeah, and in LA, a lot of those are primary residences. So
Right.
people are going to live there full time. It's another thing to buy your primary residence is $1 million. It's another thing to buy a second home that's $1 million.
Right. And then absolutely huge difference. And so that's why also too, I'm thinking, or, who knows, maybe people who are owning these second homes or vacation rentals are going to be the ones considering selling to get rid of some of their assets. But for the most part, I'm still having faith and optimism in the desert economy and the desert real estate. I think that just the fact that already Palm Springs itself, before, I don't know, right now, we haven't had the new comps, but, based on comps from just even last year or earlier this year, we were 6% higher than prices in 2006. So, we've bounced back from the recession very, very well. And, it's just a matter to see. But anyway, I don't know if you had any questions for me. I really appreciate your time, Alex. I appreciate you coming here and speaking and experimenting with my Zoom. And
It's
I
been a ton
know.
of fun. I always love chatting with you about real estate. So anytime.
Thank you. Thank you so much, Alex. And I look forward. And if anyone, they will definitely have your information. When I'll pass on the newsletter, I'll have your phone number and email if people want to reach out to you.
Next time we'll do a Zoom happy hour.
Yes, absolutely. Actually, we need to talk about that with our clients.
Sounds good.
All right. Talk to you later.
All right.
Thanks.
Bye,
Bye.
Chantal. Thanks.